Shifting gears to the U.S., so going back to our Jay wants a soft landing theme. The resilient U.S. economy does not require rate cuts, but the Fed wants to cut rates anyway. So if you look at the blue bars in this chart, this chart indicate the dot plots. So current year in the top panel, 1 year forward dot plot so 2025 in the second panel, 2026 in the third panel, and the long run dot plot in the bottom panel there. And then we have Fed funds futures rates, and then the spread between that and the prior Fed funds, or the previous year's Fed funds futures rate. And this just tells you what that spread is relative to the Fed funds rate itself. So right now, as of this morning, after the jobs report and the ISM services report, the market is currently pricing in a little bit over 2 rate cuts for 2024. Pricing in over a little bit, let's call it 2.5 rate cuts for 2025, a half a rate cut for 2026, and maybe a rate cut and a half for 2027, or getting to the OIS overnight index swap derived floor Fed funds rate, which we just take as the minimum value out 5 years on the OIS curve. So there are rate cuts still priced in the markets, albeit less than what we saw at the March FOMC at the March FOMC. So we have at the March FOMC, we were at 4.69% in terms of the December 2024 Fed funds rate. We're at 4.92% currently. At the March FOMC, the December 2025 Fed funds rate was 3.98%. We're at 4.3% currently. At the March FOMC, the December 2026 Fed funds rate at the was 3.71%. We're at 4.18% currently. And then lastly, at the March FOMC, the floor Fed funds rate, the OIS derived floor Fed funds rate was 3.49%, and it's now 3.82% currently. So we've seen hawkish movement, but it's still a dovish leaning, dovishly sloped forward rate curve, even though it's gotten more hawkish over the past, let's call it since the March FOMC, so kind of 6 weeks from now, or last 6 weeks. The Fed currently sees 2.6% as the nominal neutral rate, and 5.5% as at odds with their maximum employment mandate. And that 5.5% obviously is the current Fed funds rate, the upper bound of that. And so, in our opinion, the Fed thinks this is the neutral rate, or some version of this, because they remember the March dot plot, it went up by 6 basis points, so it's not moving a lot. So the preponderance of committee members think something close to 2.56% is the neutral Fed funds rate, and so that's why they think, oh my God, we need to cut rates because we are so much above, we're well above neutral. But as we've argued for 2 years now, that the economy is resilient. Things are fine. The neutral rate in this particular business cycle, based on some of those credit cycle dynamics we highlighted, based on this excessive monetary and fiscal stimulus that is now on the household and corporate sector balance sheet here, and the lack of cyclicality in our economy based on how the sectoral composition has evolved over the last few decades. Again, this is an economy that has a higher neutral rate, that clearly has a higher neutral rate than 2.56%, because we'd be in recession right now if it wasn't. But it's probably even higher, a lot higher than what the Fed currently thinks. And so, in our opinion, but again, this is why they're so antsy to cut, because again, they think 5.5% is really putting the screws to the business cycle. And they, in our opinion, don't want to put the screws to the business cycle. Jay wants a soft landing. He does not want a hard landing. It's very clear in his tone. It's very clear in his responses, and it's very clear in his decision-making process in terms of continuing to anchor on the dovish side of the data. U.S. banks already have ample reserves, but the Fed is going to slow balance sheet runoff anyway. So in this chart, we show bank reserves in the blue line as a share of nominal GDP, as a share of bank assets, as a share of bank liabilities, and as a share of bank deposits. No matter how you slice and dice it, bank reserves have been rising over the past, let's call it a couple of years. And the reason the bank reserves have been rising over the past couple of years is because the Fed has the Fed and Treasury for a large part of the last 5 to 6 quarters have been implementing dovish monetary policy from the perspective of forward guidance and the perspective of net financing policy. That's changing at the margin, which we'll talk about in the leftover section. But in terms of the Fed's contribution to that, they're obviously going to maintain this dovish policy. And what we learned this week on the balance sheet side of the equation is that they're going to taper balance sheet runoff on the Treasury side of things from $60 billion to $25 billion, which at the margins is positive for risk assets, and it's because it's positive for U.S. liquidity vis-a-vis bank reserves. But the key one key takeaway I'll say from this chart that indicates to us that Jay Powell, come hell or high water, may just want a soft landing and is going to put his head in the sand and ignore hawkish data is because they've pivoted on quantitative, or it's not quantitative tightening. They're not selling assets to the market. They've pivoted on balance sheet runoff at a very, very high level of bank reserves. So if you look at the black dotted lines in these charts, that indicates where that particular ratio metric, bottomed at the trough. So where it bottomed during the 2019 repo mini crisis. And as you can see, the current levels, there's a huge spread between the current level and that 2019 trough for each indicator. So the fact that the Fed is concerned about maintaining ample reserves at this level of bank reserves tells you that they want to be dovish. Their inclination is to be dovish. And so we don't want to fight that as investors.